Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 2.38% year to date. Our stock market strength color signal is green, and here are our returns that we've had year to date, comparing ourselves against the S&P 500 buy and hold investor. That's what we do here at SPY Trader Now. We want to beat the returns of the buy and hold investor. We are not meeting that goal. We are down by 8% approximately, and we got to catch up. So that is what we're planning on doing between now and the end of this calendar year. Here are some past returns for SPY Trader Now. Last week, the S&P 500 gained 0.34%. We'll go through the charts in much greater detail throughout this presentation. We made no trades last week. Here are some of the, these are all of the trades we've made in calendar year 2024. If you want to see all my trades going back for the last 3 years, you can head over to this link. The link will be down below in the description. And here we have 2 open positions. We currently have 200 shares of SPY. We're positive by $7,000 in that position, but we have an in-the-money covered call that we owe $5,600 on. So that's not total profit until we close out our in-the-money covered call. Now, my plan is to wait for this market to correct, buy to close the in-the-money covered call, then we will go ahead and go long this market. That's my goal for what I want to do. Here is the equity curve for the model portfolio for 2024 year to date. Nice and steady upward momentum. Here's the equity curve for the S&P 500 buy and hold investor, practically straight up. I mean, just unbelievable. And here are the 2 equity curves combined, because we want to compare our portfolio against the benchmark of the buy and hold investor. And so far, they are doing phenomenal. This is the Fed Chair Jerome Powell. The next announcement will be on May 1st. And we'll have to see what he is going to do. He keeps talking about having 3 rate cuts in 2024, but quite honestly, I don't see that happening. I would be shocked to see that happening with the data that I'm seeing, and that inflationary pressures are still high. And this is an election year, so I'm not sure what type of a game he's playing here by talking cuts. All right, now we are looking at things from a presidential election cycle theory. We are in the 4th year of President Biden's term. Historically, that's a 6.7% return. Currently, the S&P 500 is 10.05% up. So we're overvalued by this valuation standpoint. Now we are looking at things from a bond market outlook, which says stay out of the stock market. We have an inverted yield curve and we have rising interest rates. So we should technically, by this standard, be out of the stock market. Now, this is Warren Buffett, the Oracle of Omaha. This is CNN Business Fear and Greed Index. We are in greed, very close to extreme greed. Now we are looking at things from a seasonality outlook. This is monthly bars candlestick for the S&P 500. Now, we're pretty much closed out the month of May. We're going to open the next week's presentation in the month of April. In the month of April, there's an 84% probability we're going to close the month higher than when we opened it. So it is good to go long right now, statistically speaking, off of this basis. I've also drawn in here trend lines, monthly trend lines, to show you where we've been since this market bottomed in October of 2023. So I grabbed it at the bottom there and went up to over here to display some trend lines of pretty much how this market is rolling. So until we come out of this trend line, we are in this trend line. Now we are looking at things from a very long 20-year monthly chart for the S&P 500, and we're in a long-term bull market. as long as we meet all these conditions, and we have met all these conditions. So the only thing that bothers me is this is straight up trajectory. That's an unsustainable elevation. That's got to come down and taper off and have some type of a correction. Now we're looking at things from a weekly 5-year chart candlestick for the S&P 500. And you can see the trend line that we're in here. You'll see it closer on the next chart, but you can see here in the thumbnail straight up. Now we are looking at things on a 6-month daily candlestick chart. Here are your trend lines here. We are in these trend lines until we break them. Now this is a risk-on indicator chart with the NASDAQ 100 against the S&P 500. Under bull markets, the NASDAQ 100 symbol QQQ should be outperforming the S&P 500 symbol SPY. Currently, you can see we are on a trajectory heading down. That means that the S&P 500 is outperforming the NASDAQ 100. Generally, that's a risk-off appetite. In addition to that, the MACD has hit the signal line and now is continuing away from it and increasing its distance. Slow stochastics is already heading south. So this is somewhat of a bearish indicator, indicating what's of things to come. Now we're looking at another ratio chart, the S&P 500 equal weighted symbol RSP against the normal cap weighted symbol SPY. That is this chart that's in red and black. Then in lime green, you have the equally weighted, and in dark blue, the S&P 500. Now, we've fallen off of a cliff 3 times in the last 20 years of data. And out of those times, the S&P 500 had a 40% correction, a 19% correction, and this time, not even a correction that I want to mention because it's so shallow. So I'm expecting some more of a correction coming up here, but it has not happened yet. Now we are looking at the VIX Volatility Index, Fear Index. There are 3 zones. The ultra-low zone below this green line, the low zone between these 2 green lines, and then the upper zone up here. So currently, we are in this ultra-low range, and quite honestly, that's bullish, because when you're in the ultra-low range, the market is not concerned about risk, and the market will continue to advance upward. I don't know how much it will advance, but it should continue upward. Now we're looking at the Thinkorswim platform. This is a 5-year weekly candlestick chart, and I've got standard deviations, +1, -1 in pink, +2, -2 in gold, the regression in dashed green. Currently, we are at +0.75. We have not reached the +1 yet on this 5-year chart. But as you get closer towards it, then the probabilities are that you're going to move sideways to down because of the nature of standard deviations. Now we are looking at same standard deviation chart, except we're going back 1 year daily instead of 5-year weekly. Here you are at 0.8. So we're here. I just see small advancement, more probability of downside than upside. Now we are looking at the same chart, but now we're going back daily 6 months. And here we are right smack dab at the regression line. So this would be your very obvious sell zone and your very obvious buy zone. We are in neither one of these zones yet. Now, here is a chart that I developed to determine market strength and compare it against last week's strength. Last week, the market was extremely strong. Now, these are different asset classes, 96% compared to 90% a week ago. The 11 sectors of the S&P 500 this week, look at this number, 97% compared to 89%. We are just unbelievably strong across all of the 11 sectors. Now we are looking at a 1-year chart of the 10-year bond yields. And here is a resistance line, and here is a support line. We are right now trading in between these 2 lines. And we're right here at around this solid green line right now. You can see your MACD is heading south, your slow stow is heading south. It looks like bond yields are going to drop. That is bullish for the S&P 500, which is in dark blue. You can see the trajectory that we are just traveling north. All right, that concludes this presentation. I gave you a ton of information. Now comes the critical thinking. What are we going to do with that information? Well, as of March 30th, 2024, the market summation, according to me, Ken, your friendly host with SPY Trader Now. The market strength is still strong, but I don't like putting on more risk till this market pulls back. I was thinking about taking on this call. I never did take it on. I didn't make any trades last week. I was totally considering taking on more risk, which is this call right here. I decided not to. So I'm going to let this, because when you take on a long call, the only way you're going to make money is if this market goes up and advances. If this market stays flat, your call that you're paying money for, in this case $1,649, is going to lose money because of time depreciation. And if the market doesn't advance, time is going to wipe out your earnings. So rather than take on that risk of time depreciation at this stage, I'd rather just sit tight with my in the money covered call. I hope you've got some valuable information out of this video. If you have not done so already, hit that like button for me right now. Subscribe to my channel. Ring that bell. I thank you, and I wish you good trading.